Yeah, thank you. This is the last session for today, and I'm going to do the context setting. So, as we have seen the EFAS demand, there's the 7,750 electric trucks demand, and this could, with 46% coming from HDVs, 44% coming from MDVs and the light-duty vehicles. And I've just used rough numbers and to figure it out what would be the investment opportunity to look like if we just, this is just an asset financing. If we look at it cumulatively, this could come around around 6,000 crores, something odd number. And if you include charging infra and the ancillary upstream infrastructure, it would be close to a $1 billion asset management opportunity that just exists. And let's look at the fragmented Indian road logistics value chain. So we all know about this value chain. Looking at how fragment is here, the numbers are, India has almost like 43 million shippers and almost like 40,000 logistic service providers. And then they coordinate with the supply brokers of almost like 100,000. And then we have like truck owners, almost like 800,000. And then the shipment happens. This is the entire value chain from shippers to the end users. This is what number of stakeholders that are involved. And yeah, as we have heard, 75% of the market is comprises of small players who has a low geographic reach and low tech capabilities. And the data is average age of the MHCV in India is almost about 10 years. So these are the numbers that put some perspective around the challenges that, to move this needle further ahead. Given this background, given these challenges, and we have challenges like, capex-based issues. We have challenges like, technology uncertainty. What is the asset risk? What is the business risk? So our panel today would be working around, discussing around these challenges and coming with strategies. And without further ado, I would invite Vijay from SFC to moderate the panel. Thank you.
Now I request the moderator for this session, Mr. Vijay Jaiswal, Director at Smart Freight Center India, to take the stage. Along with our esteemed panelist, Dr. Ravindra Kumar Singh, Chief General Manager of SIDBI, Ms. Christina Albuquerque, Director of Global Electric Mobility, WRI, Mr. Saurabh Sood, Senior Transport Specialist, World Bank, Ms. Neha Nagpal, Operations Officer, IFC, Mr. Charit Konda, Energy Specialist from IEEFA. As all our esteemed panelists take their seats, we look forward to an engaging discussion on the critical role of financing in accelerating ZET adoption.
So let's be seated and we start the discussion. So as you all noticed, Neha Nagpal from IFC will be joining virtually. So all right. So good evening, everyone. This is going to be the last discussion of the day, and I will try to make it as interesting as I can. Also, given this is all about money, and money is what probably makes any change happen in real time, beyond the talks. And I'm so glad that I have a very esteemed panel with me today here, which includes Dr. R.K. Singh, Head Green Climate Energy Efficiency and International Cooperation at SIDBI. We have Saurabh with us, who is the Senior Transport Specialist at the World Bank. We have Neha joining us as the Operation Officer at International Finance Corporation. Charit, a good friend, joining from IFA. And he's the energy specialist there. And we also have Christina, who is the Director Global Electric Mobility at WRI Ross Center for Sustainable Cities. And I think, I don't know if I need introduction, but myself, Vijay Jaiswal, I've been on the stage quite a few times during the day, and I represent Smart Freight Center as one of the knowledge partners under the EFAS platform. And we, along with CALSTART and WBCSD, has been working as a task force, looking at the entire value chain, looking at the economic viability of the electric trucks, and then looking at the various risk components which emerge out of that viability model, and what kind of financing solutions or de-risking solutions would work best for us to move from ambition to action. So with that broad context, I would like to start the discussion, and I would like to start my first question to Dr. R.K. Singh, sir. So we have discussed this quite a few times, and your views have been very enriching, very enlightening. But for the sake of audience's benefit, my first question to would be that what is your outlook for ZET market development in India, and where do you see financing as a barrier for making that market development to happen? In the same context, what is your assessment of the financial risk that are associated with the lending for e-trucks, and what kind of mitigation strategies or de-risking measures would work best to make the transition happen?
So this being session last, he has thrown all the questions in one go. General financing is the last chance, but financing will only make things last. And that is very important to be noted. Coming to risk, we have been deliberating on different occasions. If I just put it, it is ABC only, which is asset, business, and credit risk. More than that, we are talking about technology, and many times we talk about replacement risk, resale risk. So bankability per se, if it can be established, I think risk can be converted into a brisk walk in terms of financing. So what we are trying to do at SIDBI is, when we worked on the EV ecosystem, we discussed with 1,000 stakeholders and tried to pick the pain points which are there in the value chain. Took a pool of bankers for an expo visit, took them to the entire value chain so that they can understand that what lies and what underlies into this. And based on that, then we have created the entire framework that how do we attend. So while we have been able to do that for 2 3-wheelers, the 4-wheeler per se, and more so on the e-bus and truck side, we have been working how to go about doing it. I can just share that we tested also the risk sharing facility. We have been doing this for last almost 8 to 10 years, where we build the market for energy efficiency in India. Now we have been working on the risk sharing side as also circular economy, and we have tested different models. One model is like first loss being borne by a facility we create, or a first loss being borne by the intermediary who are there as part of the funding exercise, or first loss is borne by the OEM also. Then there is second loss. Then there is also portfolio based, like for 2 3-wheelers, this individual guarantee was not working, so we worked out a portfolio based, where first 3% was borne by the anchor or NBFC or the financial intermediary. And then next 10%, 7.5% we are covering. So we are operating all these what I am talking about, and we are almost there to work out what we should be doing for the truck side or the buses side. And risk sharing is very important. It is not a guarantee facility, I would say. It is more than that, and that is what we call it guarantee plus, where what happens is any case which is to be covered, which are generally a new way of doing things. For example, under risk sharing facility for 2 3-wheelers, we have done aggregation model, leasing model, subscription model. So different models which in a normal course we would not have funded, we have gone about funding it. Same would lie, and we would cover this side in terms of what it enables a banker or a lender is they can look at innovative, emerging, unknown projects. And what we do from SIDBI side is we have a technical team for different themes, and that team evaluates the technical viability of that project, gives a sort of a support, comfort to the banker that we have seen the technical side. Now you can evaluate the financial, techno-economic viability part, and then come to us, we'll cover through risk sharing facility. So that way this becomes guarantee plus. And that is how it has worked on the energy efficiency side, on the municipal solid waste side, on the 2-3-wheeler, and we would work it on the truck and buses side also. So a mix. And then now coming to financial instruments, we have tested that if we try to kindle the rural mobility side of e-mobility, and there we tried viability gap funding, which was followed by creating a blended finance facility and roping in NBFCs, and blended finance was able to bring the rates to a competitive level. And third was quoting and supporting it through a risk sharing facility. So different models would work. SIDBI has almost tested all the models, and we would like to do it. We have worked out that we should be working this segment on a phase basis so that we test it and then scale it up the right way. That is how it has worked, and we'll catch up.
Definitely so. So the depth of your viewpoints have always been very helpful to kind of define how we work together. So my next question will be to Christina, and because you just heard this term economic viability quite a few times from me and Dr. Singh. So what is your understanding of which aspect of economic viability, which is also always taken into consideration, the TCO parity and the cash flow view for the shipper? Which aspect of the economic viability has a bearing on financing of ZETs? More again, like looking at how the Indian freight sector is structured, given the small-scale operators' presence in the sector, the prevalent business practices, and also the ownership models in the Indian trucking sector.
So thank you for the question. So I think it's important. You have been hearing throughout the day that this TCO analysis is one really important thing, but we need to understand which context. These need to be applicable for each context this truck is going to be used. So really go into the detail analysis and not generalize TCO analysis for all the cases. So really understand which use we are going to have and understand how we make this TCO feasible and profitable to the small companies that are the main way that the market is organized here in the Indian market. So really understand how we can create the new business models that the upfront costs for this technology is not so impactful in that. So the cash flow doesn't have a lot of impact. So we can explore a lot of models for it. So we have been hearing also already throughout the day. So blended financing, how we can bring new investors with lower interest rates for those finance mechanisms. So how we can attract climate financing for those investments, how we can monetize that in the future with carbon markets and everything that can attract better rates for really accelerate this transition. And I think for that we have more I think on the timing for that, because we know this is coming, but maybe it's coming a little bit later when we already have the market more ready, that prices are decreasing, the price of technology and everything. So how we can attract right now those kind of mechanisms to really accelerate the Indian market right now, that the India is already making a lot of signs and giving the direction where the country is going. So have all the clear, ambitious targets in place. So right now the financial mechanism needs to match those ambitions to accelerate this transition. And also another really important thing that we are hearing that was going to help on all the financial mechanisms and TCO analysis, decreasing the cost, the upfront cost, or the capital cost. So bringing more competitors to the same type of vehicles, so increasing the number of OEMs available in the market to increase the competitiveness, to really be able to commit and deliver the technology for the different types of use that we need in the different uses for the freight sector in the Indian context. And one really important thing that we can bring for this discussion, not only for the TCO, for the financial mechanisms as a role, as how we can have the warranties for the smaller owners of vehicles. That's a big part. So when you're talking about big owner fleets, I think it's much easier to them to be able to pay and have these guarantees as part of their financial mechanisms. So how financial institutions, development ones like World Bank and the others here, can also help to leverage some money for de-risking those investments for those ones and help attract some more private investors to the table on it. So exploring those seed monies with development banks that can create the market and accelerate that without needing necessary subsidies for the government itself. So how we can use those climate financing and development banks mechanisms for accelerating this transition and really seeing in the market picking up in speed for this acceleration to be able to commit with all those targets that we have. So really being able to go into the details for the different uses and creating those mechanisms for different users to create the innovative business models for accelerating that.
Thanks, Christina. That's very, very helpful. My next question is to Saurabh, and he represents the World Bank, so a multilateral development finance institution. So, Saurabh, what's your view on what kind of financing solutions would work for large-scale ZET deployments? And what role at an ecosystem would each stakeholder play? And as we talk about stakeholders, so government, the private sector, multilaterals play in developing and deploying such financing solutions for scale ZET deployment.
Thank you. So just to carry forward from what Christina was saying, I would say in addition to having very use case specific TCO models, the other equally important element we need to look at is the ability of the user to repay the loan, because ultimately that is what is going to determine the bankability. And if an asset is going to cost about 3x or 2x an ICE vehicle, probably with the same tenor and the same rate of interest, his EMIs are also going to be in that proportion itself. So it's equally important we need to keep the EMI at the same level or at a slightly increased level so that the bankability does not suffer. And from this, I move to 3 or 4 specific broad cases where we can look at with specific different models of financing and business models that we could look at. So first of all, let me talk about urban freight. In urban freight, there are primarily 2 categories. One is the municipal vehicles, the municipal fleet which is there. The second is the logistics service providers which run the smaller vehicles. Municipal fleet all across India can serve as a very good candidate for demand aggregation, just like we've done in the case of STU buses. And I must admit that in some cases, the TCO may not be achieved in the near future for municipal fleets, some of the municipal vehicles. So a similar example would be that of a school bus. So school bus, we are sure that achieving a TCO in the near future is very difficult. So something like a garbage picking vehicle or a water tanker or something may have limited TCO parity, but still it needs to be greened. The second is urban fleet, which is owned by the private logistics players. So over there are already state-level subsidies which are enabling adoption of green vehicles, the smaller, the N1 vehicles, which are 1, 2, 3 ton vehicles. I think the ACE and other EVs which are there, they are already operating. So the TCO in that case is established because the number of vehicle kilometers is going to be significant. They are going to benefit from a lot of charging infrastructure which is already going to be present in such cities. And the smaller vehicle size means that the payload penalty is not going to be significant as well. So that is a good candidate to, or sort of a low-hanging fruit that we could look at. The third is, and somebody made this point earlier in the day, that we could look at some closed-loop systems. So some vehicles in the mine, some vehicles in port and CFS and back to the port. Those are the vehicles, or even port ITVs, those could be the vehicles which again have predetermined or a foreseeable vehicle kilometers per day. So we can, and have high utilization, so TCO parity is probably achievable, and they have a fixed revenue stream as well.
Right.
The third and final is, I come to the regional or the heavy duty trucks. So over there, we need to be cognizant of the fact that, say, unlike the passenger vehicle segment market or even the bus market, there are a lot of systemic and sectoral inefficiencies in India's freight sector. We are aware, and the reports published, that almost 40% of the vehicle trips in trucks are empty trips, the return trips.
Right.
If that impacts the revenue potential of a player, then it impacts his probably the ability to adopt a new technology, which is much more expensive. And then, so probably I'll just end my point here. I would also want to focus on the two major segments in the market, like we were seeing in the presentation, the 40% market, which is the organized sector, which probably is going to be the early adopter of technology. They have access to finance, they have probably, but the requirement that they will need is long-term, low-cost capital, probably accompanied by a risk-sharing instrument, maybe. We are still working on that, on what kind of risk needs to be mitigated. One of the risks might be for both the bankers and the early adopters would be the residual value or the resale value risk. Then comes the second-hand market, which is also equally important. It comprises 70% of India's trucking market. Without that transition from the first owner to the second owner, there'll be no more supply, no more demand which will be generated by the first-hand owners or the large service players. So the second-hand owners have a separate problem. They face challenges in access to finance. They have high credit risk. And any institution that finances that category is probably going to require more credit guarantees, more sort of risk-sharing facilities in them. And then how they kind of repay the loan, how they are able to access finance is a different challenge altogether. So I'll probably stop here and I'll pause for the other participants also.
Yeah, thanks, Saurabh. So I'll now go to Neha. Neha, are you able to hear me?
Yes. Am I audible? Thanks, Vijay.
Yeah, great. Thanks, Neha, for taking out time from your busy schedule and being remote and still joining us. So, considering you represent International Finance Corporation, I would like to know the kind of role that you envisage for your organization to play in the acceleration of ZET ecosystem in India, and especially with the participation of the private sector companies in this sector. And what signals from the market and policy maybe would trigger an action from an institution like yours?
Sure. Thanks, Vijay. So the objective for IFC, an institution like IFC, would be to finance large-scale infrastructure projects that can support a climate change. So here, I think there are a couple of points that have already been touched by the panel members. For example, the TCO viability for select use cases and bankability of the contracts. So for us to enable large-scale financing, that is moving from the 5-truck pilot to, say, 100 trucks or 1,000 trucks sort of financing opportunity, bankability, of course, is extremely critical. And I'll be brief on that since that's already been touched. Longer tenure contracts for us, demand aggregation and volumes is something that can support bankability. Now, volumes and demand aggregation in theory and in practice is huge difference, and largely because asset ownership is a challenge in the ZETs space. So, I mean, if we look at the asset ownership, what really is what are the two key bottlenecks that we see are the entry barriers and the residual value. Now, when you look at the entry barriers, this is almost 2.5 to 3 times. And residual value, we do not know what sort of technology will prevail in long term, and whether the trucks can be recycled. Again, both these, policy support can help on both these parameters. For example, on the entry barriers, if we look at the truck cost or the tractor cost is comparable to on the electric side is comparable to the ICE trucks. But the differential really comes from the battery part. Now we know the battery prices are falling, and there could be a case where they are 50% of the value that today they are. But the policy barriers do not enable the battery swapping to happen, and that also kind of limits the type of financing interventions that can come in. I mean, internationally, we've seen battery banks supporting battery swapping models, and those also support different types of use cases, which is beyond the closed loop operation, say on a corridor approach. So I think policy intervention on that front should help. Again, the residual value, the clarity on what sort of technology would prevail in long term, the government, inputs on that front should help. Having said that, I think both these issues on the entry barriers and residual value can be addressed through asset ownership models that have evolved over time. These are largely asset financing models that can support financing of larger volume of trucks. So essentially, demand aggregation gets taken care of, operational efficiencies get taken care of, financing efficiencies can be built into such larger ticket size deals where multilaterals and blended finance instruments can be brought in. Of course, there are issues to be addressed on how we can make the market switch to longer tenure contracts. Again, volumes should help, and offtake arrangements should also help. So I'll pause here for any reflection. And
Thanks, Neha. And Charat, I actually was waiting for all these views to come forward to have your viewpoint. And as we all know that you represent IFA, which is the Institute for Energy Economics and Financial Analysis. So now I probably will try to look for you to summarize your viewpoint looking at all these inputs. And tell us that what is the global best practices on energy finance that you think would work well in the context of ZET financing in India, including the financing as well as the business models.
Sure. Thanks, Vijay. Thanks for having me here. Being the last speaker in the last session is not easy, but I'll borrow some of the points that the earlier people spoken about. So there are various green funds out there globally, as Christina was also mentioning that there are climate funds, there are green funds that are already existing. And all we need is, I would say, a well-designed downstream financial instrument that could channelize these funds profitably. Now, many of these, why is the reason, the main reason behind the high financing costs that we are seeing could be reasons like high upfront cost of the vehicle itself, and there's lack of performance data, there is lack of residual value. So each of these, as we're seeing in globally international markets, is a well-structured, tailored instrument that is addressing these risks. So some of the examples, I won't read all through, but I will just cite you a few examples when it comes to dealing with high vehicle cost, which kind of has a multiplier effect on other financial metrics as well. Is if we can somehow have a concessional loan which is being implemented elsewhere in the world, like South Korean government has instituted a concessional loan which extends up to the 50% of the vehicle cost. So this in fact has an effect on the private sector lending as well, which kind of lowered the interest rates on the private sector loans as well. So that's kind of leveraging, as some other speaker was saying. Right now we are financing all through equity. If equity can be replaced with debt, that shows the maturity of the industry. So I would say that's one way of doing that. And also if you can, even the OEMs can play a part, like Daimler is, I don't know if they are here in this workshop, but Daimler has issued a €1 billion dollars, 1 billion euros, in fact, as green bonds and try to finance their own vehicles and then give it on an asset leasing model, which can also be perhaps replicated in India. And that almost got 25 basis points advantage in terms of the normal loans. So likewise, there are vehicle lease programs which are done by insurance companies. Perhaps Indian auto insurance companies can also look into that, like Lombard does it in UK, Asset Alliance Group in UK, along with the NatWest Group. And even the OEMs like Hyzon Motors did. So some of these even the mezzanine loan from European Investment Bank, which kind of converts into debt if there is a default. So this kind of instruments, this kind of interventions would certainly help. I mean, all we need is a good, well-structured downstream financial instrument. Yeah.
I totally agree with you, Charit, on that. So probably my next round of questions will take a pause here. I would like to invite some questions from the audience to the panel. So not just to make it interactive, but we know that from the day-long deliberations, you have a lot of questions. And I also see some representation from the industry. As in, we have a company which is into asset leasing, we have LSPs here. So I would request if anybody wants to raise a question directly to the panelist, so that I can take a break, maybe. Anyone? This is a surprise, but still a good one. Anybody wants to take a call? Karthik sir, you have any question? You have been leading the PSA office work. You will ask later. Anybody? Yeah, Urska.
Yeah, I have Urska from WBCSD. I have a question for IFC. What is typically the size of the project that is relevant for you to invest in?
So Neha, you got the question. What is the size of the project that you will be looking at to take a decision on investments?
So typically a sweet spot for IFC would be about $50 million. That's just a very generalized average. Given the context of this particular industry, its development impact, and the need for us to create market in this, I think our thresholds are much lower for such an industry or such a industry subsector. In fact, we put our resources together to sort of create asset co platforms so that we can actually create market along with them. So I mean, it varies, but again, the debt/equity would depend on how bankable, what sort of bankable contracts can we structure as part of the asset co or as part of the investment.
Urska, you got your answer. Yeah? Thanks. Yeah, Mr. Ganti Radhakrishna, please introduce yourself as well.
No problem.
Sorry, sorry. I missed on this. Abhijit ji, probably you go first, and then just give me 2 minutes, Mr. Ganti.
Probably it's little knowledge that we want, because two of very eminent panelists who are there on this panel have been involved into making a risk management instrument for a period of time between SIDBI and World Bank, and I have heard wonderful work has happened over a period of time. When we were doing annuity hybrid e-mobility, we did not have that instrument, so we could not integrate at that time. So if somebody, for instance, say for an example, 500 to 1,000, why I'm saying 500 is because of Tamil Nadu outlay from the annuity hybrid. If we have to do it now, how you have done it, what is that we should keep in our mind, that state should take some load of it, some subvention, some sort of load on the interest. RBI has a sovereign green fund. They have also issued and sovereign bonds now in India. How these can all come together and we can join these dots to give some confidence to the risk management, at least 1 to 2%.
So the question is to Singh sir or to Saurabh?
Saurabh.
Thank you. So first of all, the bank and SIDBI have done excellent work in creating a risk-sharing facility for the two-wheeler, three-wheeler, four-wheeler segment. But having said that, that market and the trucking market are quite different. The average number of delinquencies or NPAs in the passenger small vehicles is about 15% or so. For trucking, it's 0.6 or 0.8% only. So we need to be first clear about what is the risk that we are trying to hedge or de-risk here. It could either be credit risk of the borrower, right? It could be the revenue risk, which anyways the bank will not hedge. It could be an operational risk. Suppose I purchase a truck tomorrow, it doesn't operate. Fourth, it could be a technology risk. So for that, we have the OEMs and the battery manufacturers providing warranties and guarantees we noticed early in the day. The fifth could be a resale risk, which is a very real risk in the minds of the lenders and the borrowers both. Then there is a sixth category of risk, which is the perceived risk or the risk of the unknown. We don't know what it is. It's an untested, untried technology. There's no data right now. That is what a lot of bankers and banking institutions have also mentioned. Now, having said all of this, we are now faced with the challenge of quantifying certain unknown risks and some perceived risks. And that is the way we have to sort of balance all of this. There could be a kind of an instrument which could be a guarantee instrument, which guarantees for a percentage of a second loss or a first loss. But there's no one-to-one correlation that a guarantee instrument or a risk-sharing facility actually works in favor of reducing the cost of lending. It depends on who bears that cost of guarantee. Either it's the government or it passes on to the borrower. Now, among all of this, we have an equally important challenge of reducing the capital cost, which is 3x of the diesel price. So how we balance everything and how we let the market up that technology adoption curve is yet to be seen, and we are working with SIDBI and other organizations and the financial institutions.
So that's the follow-up question, that RBI bond, sovereign green bond, that can be used to decrease the interest rate or not. It's there in the mandate written.
That could be looked at, but so we need to look at how the phasing of the adoption of ZETs is going to happen. And what kind of numbers of trucks we are looking at, what kind of equity, what kind of debt financing we are actually looking at. After we've done all that, then we look at what kind of risk profile is there for the borrowers and what kind of financing instruments are there. So we looked at, there are some climate financing, some green finance funds, then there are the green bonds, then probably India is in process of developing its taxonomy as well. There's so many instruments which are possible. They could probably, I'm just thinking, they could probably be clubbed into a kind of a fund, a revolving fund, a concessional financing clubbed into it, with the risk instrument clubbed into it. There are numerous permutations, combinations possible in this.
So I will complement this. So we have recently got sanction of 200 million from Green Climate Fund, and we would leverage it to create a 1 billion fund, and that is not exclusively for EV, but it is for green financing. And this blended facility, it's a concessional fund, will blend it with market borrowing, which SIDBI would do, and will create this 1 billion fund, which we intend to leverage it to 4 billion. So the idea is, because any project, this will have promoter contribution, this will have bankers also funding only 75%. So we have worked out this module, which includes the solar side, the EV side, the energy efficiency side, and circular economy, and including the adaptation side. Now coming to, so the fund side, I think we are working on. We also manage this GIFT program, Green Investment for Transformation of Ministry of MSME. Though we are catering to micro and small enterprises, but loans up to 2 crores, we are providing 2% interest subvention. So that also is up and ticking. Now third is like what we have done while funding EV 2-3 wheelers is, generally a banker would love to have a menu card identified, right? Like for example, energy efficiency, we have created a stack of 890 technologies which are clean, green, energy efficient. Same we have done for EV. We have empaneled 18 OEMs and we have empaneled them based on the technology, the quality criteria, right? And then once we empanel the lenders like NBFCs, like we have funded few NBFCs which are BBB and below rated. Generally, we would not have funded, but backing of risk sharing facility has enabled us to fund them. And there what we tell them is, we would insist on telematics being there. We would insist on particular quality, as you were mentioning about battery quality. So we would look at the entire ecosystem being built up, then only funding. So if a stack is there, the banker has a ease. Like today my SIDBI branches are at very much ease. They know these OEMs I need to look at, whether it is battery, whether it is the vehicle manufacturer. And these NBFCs have passed through a filter of a green vertical, so they are very convinced. Same model we have now taken to the other part of, means other partner banks. So this is what would work out. Another thing which we both were sharing the same DAS was how did we sponsored this K2K, Kanyakumari to Kashmir, say women traveling 3,333 kilometers and proving this that one, women can drive. Second, these vehicles, 2, 3 and 4 wheelers EV can be driven from Kanyakumari to Kashmir seamlessly. And that is what, this sort of proving the efficacy that this truck can fly from one end to the other end, I think would be the one way which we call it that financing need to be complemented by non-financing.
Sir, consider Bharatmala and Sagarmala done.
Vijay, if I may
Parvatmala in coming
interject.
time.
So actually, I'm also looking at the clock, and we know what's coming next. And let's not keep the audience waiting for that. So I would like to maybe, sorry for that, we can continue the discussion on the food and the drinks. Mr. Ganti Radhakrishnan, your question, please.
Good evening, everyone. Myself, Radhakrishnan, I represent Renes Logistics. So my question is very simple. As a logistics partner, I'm the person who is investing. I'm the person who is working in the thin margin. I'm at the risk rather than the shipper and the other people, right? So what can I expect from the financial institutes in coming days? Is there rate of interest can be reduced, reduction in the rate of interest to support the industry? Point one. Point two is there any facility that government, anyways the subsidization is not there on the trucks. Instead of subsidization, if they could reduce the rate of interest on the vehicle, anyways my rate of what I'm purchasing is 3x times. If the rate of interest could reduce, then it will help us a lot. We can manage a little bit on this front.
And who is your question pointed to? Is it Singh sir or?
I will feel.
Okay.
So, very simple. Like banker, typically, you have to really make them in-depth aware about bankability. Right. So that is what, as I mentioned earlier, if you have heard, we took a pool of 50 bankers to a EV Expo and had a structured discussion with the entire ecosystem, right? Battery people, the OEMs, the charging stations, the swapping thing also. Unless we understand, we will not fund, right? And once we understand, the market then starts operating. Right? The interest rate is related to the bankability or the perceived risk being brought down. Right? So the first thing for you would be to convince us what is the entire model. If you'll keep the model in your pocket, then we would also have issue in, unless we understand, we'll not work on it. And second is, so once we understand, like 2-3 wheelers we could understand. So what we have now done is, for example, we want to prioritize that women should go for EV, right? So we have lowered the risk premium for women and in calculating our interest rate. So similarly, whichever segments will create, that is how market works, for you also, for me also as a banker. I think only thing is give clarity to us.
Yeah, so while you said that you are the one investing the money, but I think you also have a role to play to convince the banker that the rate of interest can be lowered, apart from other players as well. Am I right in saying that? All right. Probably next 10 minutes, a few more questions, please. Of course, I have my set of questions, but I think this is a better model where we hear from the audience what their questions, what their doubts, what their concerns are. Anyone else want to take a stab?
People want to leave early.
Nobody is leaving early, for sure. Yeah, please.
Good evening. I'm Rahul Upmanyu from Entrepreneur. I think this question has been in my mind for a year. A year ago, though, I asked in a petroleum ministry organized conference.
Can you just come a bit forward because it's not very clearly audible?
Yeah, sure. Thanks. So I think from an India perspective, I think this is a pretty broader question in a sense that when we talk about energy and our dependency on it. So 82% of the fuel or the energy that we currently use in India are imported, right? Fundamentally, that is what the general scenario is, statistically speaking. Now, we also have refineries. So there is a dollar component which is going out in terms of the market. We are borrowing the energy from outside world. Now, when we do refining of that fuel and we export it, is there a way via which we can offset it? Somebody has thought like that ever before?
So my first hunch would be that this is a discussion on finance.
On finance.
Yeah. So I'm not able to see that.
I can correlate it with finance.
Please, that correlation will be helpful, please. If
Fantastic. So when Sir mentioned that SIDBI is doing ABC, and one of the ways via which SIDBI is propagating its initiatives is participation in experiential events. Any other framework via which SIDBI is working on in terms of marketing what they currently are into, so that SMEs, startups, or energy people in general can benefit out of it? Thanks.
Okay. So I will tell you, we started a new way of working out a model, right? So we were working out on decarbonization. How do we create a facility for decarbonization? So instead of doing for a sort of a theory or say doing a survey, we floated a challenge fund, right? And we thought that startups, innovators, the people who are thinking aloud in a different off-track models, like you, they would come across and pitch for. But we got more than 100 proposals. We have picked up 20. Only 2 proposals I could get from EV segment, right, which we are supporting. So the idea is, and the challenge fund is very simple. If you have got an idea, if you can pitch and convince us that this is a replicable, scalable idea, we would support it for doing it for say 3, 6 months or 9 months, right? And you come back proving your idea and making it for the nation to really scale it up. So as I mentioned earlier also, everything boils down to you making us understand that this is a fit model. But later on when we discuss with startups, they say, I didn't come across this. This is a public advert we give calling for challenge fund. And I was thinking I should get 1,000 proposals, but we got just 100, right? So my thing is, these sort of initiatives are being done around. You have to keep tracking that where are these sort of challenge fund or some idea, like somebody mentioned about hackathon, right, are happening. Come out and pitch with your off-track ideas. I think nation is working to support one or other way.
Yeah, so let's not make it a SIDBI open house. Yeah, so any other questions that we have here? Else, yeah, sir.
So I'm just looking at, we've got OEMs who've got truck products. There's a lot of visibility and there's a lot of clarity. We've got a lot of chargers who've got products, a lot of visibility, a lot of clarity. When do you think we'll have clarity on fiscal products like that for the sector? We need fiscal products. We need various products with just like an OEM is expected to offer different models to take care of different segments. And we complain about lack of models availability or chargers. I say, oh no, these guys don't give me beyond 150 kilowatts. What do I do, etc. Should the finance sector be rethinking their role in this entire thing? Should you be designing products, advertising them, and offering different variants of your products? It's one thing to be waiting for others to come and convince you. It's another one where if it becomes competitive and you're actually desperate to give out debt products, then you start advertising and you start competing, you start designing, you start innovating. Is it possible at all? Or are we going to be in this case where we still do not have clarity on fiscal products coming out on the table for consumers to choose from? The consumer is got the choice in vehicles. He's got it with discoms as well in some of the states. He's got it for the charger. In equity, it's started happening. He's got options on who to go for equity. Debt, we are not seeing that as yet. So what's going to drive us there? Or is it something which we will never reach? What's your thought?
So he has restrained me to answer.
No, that's not the case. So I think Karthik sir helped me that he has not pointed the question to you. So anybody is open to take the question.
Okay, so
You
I'll
can also take the question.
I'll try to answer that question. See, as the market evolves, as we go along the technology adoption curve, there will be different kind of business models which will crop up. There are startups which are doing a lot of beautiful things. There are going to be, what we are discussing, the leasing companies which are coming up. Then there are going to be asset companies which are going to come up. And they will require a different kind of a customized equity or a hybrid instrument. So even in equity also, they have the concept of junior equity and other things also which have come up now. Now, that is on the equity side. But at the same time, they also require some surety on the resale price of the vehicle, on what will happen in case it's a specific kind of a lease where the residual value has to be determined. And overall, what is the policy environment going to be? So that is also going to be an enabler of the adoption as well. But now if I come to the debt part of funding, I think first of all, we need to understand which specific segment we are going to target, because it's a very, very diverse segment. It has multiple layers of operators, levels of adopters who are going to be there. If I were to kind of look into the future, it would be the large fleet owners who would probably require low-cost, long-term financing with a higher loan-to-value ratio. That is the primary concern amongst the adopters. And they are the ones who are going to put their money on the table along with the bankers. If we are able to sort of increase the loan tenor from the existing 5 years to say 8 years, 10 years, along with suitable interest repayments, while at the same time ensuring that the EMI repayment, what I was talking about earlier, does not make him suffer, we probably could look at a very simple debt product along with some kind of a risk assurance. That could be the most plain vanilla instrument that we could look at. The others could be kind of, as I said, the business models evolve. There could be use case specific models that we could look at. So if it's a case of a demand aggregation, it would be a different kind of a financing mechanism with a business mechanism. If a private sector takes initiative on, say, anything as a service, so it could be trucking as a service, charging as a service, or mobility as a service, that could be a different kind of a model that could be adopted. And as Sir was saying earlier, we probably would like to hear from the private sector what kind of business models, established bankable models are they looking at, so that we could devise suitable financing instruments. And let me also conclude that probably there is a possible financial product for every kind of business model that we can envisage, and we need to probably work together to build that up.
Yeah, so...
I hope that answers the question.
Yeah, so Neha, you want to add to that, please.
No, I could add to that. So I think Saurabh's laid it out very well. There are different use cases. Each use case has its own sort of risks, and that would determine the kind of financial structure that would be deployed. So, for example, at this point while we are talking, we are evaluating asset co-structures where different use cases are being structured under different SPVs. And each of these SPVs have different risks. So different sort of, risk mitigation measures, different sort of tenors, structures are being evaluated. If you look at the EV buses space, there are different risks. There is a PSM, there is, payment security mechanism that enables us to take larger risk. The rates can be different, the tenors can be different. The technology risk is tested out for a longer tenor. The residual value and the deployment of the asset can be done differently versus a truck or a zero emission truck, where especially the heavy trucks category, that has a different risk profile. Especially, it depends again on the off-take risk. How is that being mitigated? So the tenors, the instrument would largely be a function of risk. At the same time, I think we have a lot of appetite from the development institutions' perspective to even look at equity. So we are looking at equity in fleets, asset ownership in fleets for say passenger cars or taxi services. That's another area where different sort of risk is there, and we are happy to take on equity sort of products. So I don't think there's a template available. Then again, there are, we would be happy to look at sort of financing the batteries. If there's a model that evolves and there's a policy enabling, framework that comes up that helps us localize the battery manufacturing, so the battery and the energy component could be segregated, and a different risk model could come up to finance that. Technically speaking, then the operators, the mom and pop truck operators would have zero switching costs. They are just switching from the current truck price, which costs roughly around 40 to 50 lakhs, to another electric truck cost, which costs somewhere in the same range. So that would have a different financial structure to it and different instruments.
Sir, I started the session with you and I'll close the session with you. I'll probably bring in Christina and Charit. What is your view on this question? What kind of examples you think we can look at in the global markets, in the global landscape, that we can build upon? Some ideas. Christina, you first.
Yeah, thank you for that. So I think you have some really good examples that you can inspire and see how they can be applicable for the Indian context. But I think the main thing is that we don't have one answer that solves all the problems. We need to understand which one of the markets we are looking for. So light duties, heavy duties, and see which role each one of the players can play on it. So in the financial side, the development banks can play a role depending on batteries. So helping to accelerate the batteries. The private market can play a role when urban freight, because then we can look for bigger owner fleets. So really understand the different applicabilities and which stakeholders need to step up to solve that specific problem. We are not talking about one problem and one solution. So some examples, we have California that's advancing a lot, have a lot of incentives since from the private sector to buy the fleets, but also looking for taxes that go for fossil fuel vehicles that can be used to accelerate the zero-emission vehicles transition for that. So how we can cross those incentives for emissions to fossil fuel vehicles that are bought in the state to transition to incentives to zero-emission vehicles. We also have another example looking for a country, China, that's doing a lot during the last years. They are not looking for the supply chain as a whole, but also how they can have a plan for decarbonizing the entire freight system. So they are having the plan which segments they can go for zero-emission vehicles. So they have mapped all the country between which cities they are going to do corridors for that, and they are doing all the infrastructure for that, but some other segments that the technology, they are not seeing the fit for zero-emission vehicles, they are going for rail on the segment. So really looking for that comprehensive plan and looking which solution is going to play a role on this broadly plan and which stakeholder is going to step up to solve these different problems. So having this comprehensive approach and understanding who can play which role to solve that specific problem. So
Great.
In terms of time, I'm going to leave you with these two.
Charit, your views on this?
So I think when you're looking at debt...
If I will just, so we are basically looking at possible debt product models that we can bring to India.
So it need not be looked at the borrower level itself when you are talking about debt. It need not be always at the truck operator. It could be a financial company which is providing a lease program as well. So especially when you are looking at asset lease programs or a trucking as a service, if you are looking at, these are very structured financial or operating leases, or it could be a pure play hire purchase lease. In that case, it's been happening, as I said earlier, with Lombard and NatWest doing in the UK. So the company is providing a service, transport as a service or trucking as a service, but it's all financial innovations are being done at that company level, not at the borrower level. The borrower just pays the per kilometer basis, as we are seeing in the CESL bus programs as well. If some of those lessons can be replicated in the trucks, if some of those are the structures.
So, your views on this? What kind of debt products would work best? Or if there can be a variety of debt products that the borrower can look at?
So as I mentioned, we have already been understanding the market, right? So when 2-3 wheelers was there, we have a different product. Maybe for buses and trucks, we'll have a different models. And that is what is the approach. How do you induce excess and reduce excess? The second part is EXCESS, right? So how do you, the disablers, how do you minimize? And enablers, how do you maximize? Is what SIDBI tries to understand. So as a debt product, we are already having, not for trucks yet, but for EV, we are already up and running. We have created a reasonable portfolio, I would say, with 35,000 vehicles on road in terms of funding in a short time. So structuring we have done along with World Bank, we have shaped how do we do for buses and trucks. And that should not be issue. Issue is we should get started.
I totally agree, and I think we are working towards that, and probably in the 3rd anniversary we will have a lot of things to talk about in terms of actual on-ground experience, data and information. So I think with this, I would like to bring this panel to a close. And I would like to probably invite Urska to come on the stage, join me, not for any more questions, but to give a thank you remarks.
Yeah, I will try to keep it brief. Thank you all the speakers first for sharing these insights. Some of the key points that I think we heard already throughout the day today. So total cost of ownership is the key. We need to make sure that the business case is viable. I think this is the message that we already heard this morning. We heard now that it's the right time. We need to shape solutions. And we also need to make sure that these solutions are innovative and that consider the needs of specific use case. So one thing that is crucial is also information sharing in between the industry, in between the financial institutions, but also within the governments, so that we really identify and bring to the market solutions that can make scale for the trucks and the infrastructure. One additional note that I would add is many times we see, also speaking internationally with different institutions, that there is not a lack of climate funding or the private equity funding. It's a lack of viable use cases, viable projects, which is many times the case of lack of information and information sharing among the project. And what is crucial is to understand how we can leverage the demand signal that we did, how we can leverage the aggregation so that we can reach the scale that actually allow us to de-risk and finance the investments with the supports with the climate funding. And I think I will leave it at this. I just want to flag that, as Vijay mentioned at the beginning, with Smart Freight Center and CALSTART, we're working in India, but also globally, as part of the Collective for Clean Transport Finance, to bring these three things together, the governments, financial institutions, and the private sector, to identify how we can develop a roadmap for financing the projects. And I forgot my flyer on the table, but we have distributed around a bit of a work plan, which is invitation for collaboration, so that we can really start this dialogue and we can together start shaping the solutions. Thank you.
So the panel comes to an end, but I would request everyone, whomsoever has any idea that you think can enrich our work, make us deliver better, please come forward, engage with us. We'll be more than happy to hear from you. Thank you so much, Dr. Singh, Neha, Saurabh, Christina, Charat. Thank you so much for this very engaging discussion. Thank you.